I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Superior, Colorado. Welcome to the show, Rick.
Thanks very much for having me on, Jim.
I remember the days of hyperinflation. Back in the late 70s, early 80s, we even had a price of living bonus in our paychecks. Every 3 months they'd adjust them because the price of living had gone up. Well, they're talking hyperinflation again. Is that likely?
Very unlikely, I would say. I would say that also that the 70s gave us inflation, but not the extreme of hyperinflation. The extreme would be something like Weimar Germany in the 1921-23 period, where they were adding zeros to bills on an almost weekly basis. So we haven't had that, and I don't think we could, actually.
Well, I'm thinking about Zimbabwe, where $1 trillion is worth about 79 cents.
Yeah, and Zimbabwe was, I guess it was an easy case, because you had a money system that was really limited to Zimbabwe. The currency didn't trade outside of Zimbabwe's borders, but it's something, again, to suggest that we could have the same experience, a hyperinflation, with the world's reserve currency. And one of the reasons that I think hyperinflation is impossible, and also another reason why we're going to stay on a dollar standard until there's a crisis that causes the dollar to collapse, is that all the players, the whole global shell game is reckoned in dollars, and there's no alternative currency that you could use to facilitate the erection of a quadrillion-dollar derivatives bubble, which is what we have.
China, of course, has ambitions of the yuan becoming the superior currency in the world. Do they have any hope of actually achieving that, considering their current economic status?
Well, I think the Chinese are real smart about it. You know, the United States has always considered it a plus that we were the world's greatest this and the world's greatest that, and we have the world's strongest currency. I think the Chinese would rather skip the blather and have their currency be strong simply because their economy is strong. So I don't think the Chinese are purposely focused on manipulating the value of the yuan or even having it trade higher over time. Those things will sort themselves out. The Chinese are more ready to accede to the forces of the market.
China, of course, some have accused them of trying to provoke trouble in the, I think, South China Sea by making artificial islands. On the other hand, I hear the Chinese aren't interested in war. What they're really interested in is somehow promoting their economy.
That's pretty hard to believe. You know, it's not merely that they are occupying islands; they're actually building them. These are little. They're not even coral reefs. You know, they pile up a lot of mud and concrete, and they come up with something big enough to put to land, well, a plane, but perhaps even a fighter jet. But they're asserting with the construction of these islands, they're asserting control and legal jurisdiction over the areas where the islands are built or exist. And these are disputed waters. Actually, in some cases, it's beyond dispute that China is not the sovereign authority in particular parts of the Pacific. So, I think it is correct to assume the worst, that they're not just there to promote trade. They're there essentially to dominate the Pacific sea lanes all the way to Hawaii.
And of course, what if they went and started building artificial islands around Hawaii?
Well, it would be the same thing, really, relative to the U.S., coastal U.S. It would be, that would be very comparable, and I'm sure not only would Hawaii be upset, but before long you'd see California, Oregon, and Washington similarly annoyed.
That really is some kind of a concept, isn't it? Somebody building an island next to what you considered your sovereign territory, or right in the middle of it, and then planting their flag on it.
And then, of course, they weaponize it, which that's the straw that broke the camel's back, although I'm hesitate to say that would occur with the current administration in Washington.
So, taking a look at deflation, are things going to be lower in price in the future?
Well, the lower price thing is, I guess, the benign aspect of deflation, and we've seen that most clearly in consumer electronics. But there are other forms of deflation that have yet to precipitate out. The biggest and most obvious of them is the destruction of brick and mortar retail in this country. And right now we've got an enormous number of the big box stores. They're going to be vacated eventually because it's pretty clear that the biggest retailers, not only the biggest but the sharpest, Nordstrom's, Macy's, Kohl's, Target, business is diminishing. It's actually spiraling downward at a much faster rate than anyone had anticipated. So we have now, but we'll have later even more empty buildings, and the capital invested in those buildings is going to disappear. But there are other. The easiest way to understand deflation is a statement made by C.V. Myers years ago. Myers was a mining engineer by training, but he put out a great newsletter called Myers Financing Energy, and he also had a book out with a 1976 copyright called The Coming Deflation. He was a little bit early, but the basic idea was that in the end, every penny of every debt must be paid, if not by the borrower, then by the lender. And you can see that happen if someone might say, well, I'll just walk away from this house. I can't pay the mortgage. And it's not that in that case, the debt's going to be paid by the creditor. So one way or the other, we've got to pay. Another way, more insidious, in other words, more well hidden, that we're going to pay in a deflationary way is in all of the extravagant pension promises that have been made to employees, both public and private. We know now that the funds, the money that is set aside to generate income to pay those pensions is not getting anything near the returns that it should in order to make good on the pension obligations years down the road. So I predict there's going to be a civil war at some point because the government employees are going to be, who retired at 55, by the way, are going to be receiving pensions that are taxed out of the few of us who remain, who've got jobs and who are working till we're 90. So that's going to be a big problem, and it's not one that you can inflate away. Monetization makes inflating financial assets very easy, but you can't inflate a pension system or a Social Security system or a Medicare system that is going bankrupt. The reason being, you're not pumping up an asset, you're sending checks out to recipients and to service providers on a daily, weekly, and monthly basis. So you can't, there's no helicopter money possibility to bail out all of these systems, which are not just bankrupt in the future, but in the actuarial sense, they're already bankrupt, Social Security being the biggest example.
Well, in Europe, where they have negative interest rates, pension funds, insurance companies, and banks are in serious trouble.
Yeah, and that's the flip side of, you get rates down so that government borrowing is cheap, but, what does the government need to borrow to spend money on? and it's certainly not productive assets. The government produces nothing. So to the extent that you deny savers a return on capital, the capital goes to the wrong place, namely the government. So, if you can't see the downside really to these low interest rates, then perhaps you don't have any savings, but it's definitely skewed capital egregiously toward malinvestment. All the money is going into all the wrong things.
Well, if negative interest rates were such a good idea, how come they've never been done until now in the history of human finance?
Well, because when they lowered interest rates step by step, they got to zero, and what else could they do? At this point, there's not even a chance that we're going to have any tightening. The Fed did a very token, we're going to try to walk the walk tightening of 25 basis points, and it absolutely blew the markets apart. So even though Yellen still talks as though tightening is possible, it's not in any significant way. And again, as we've seen, even a token tightening is enough to set the world on a potential implosion.
We'll have more with Rick Ackerman right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to West Vancouver Friday, May 6th at the K-Meek Center. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Rick Ackerman. Rick, getting away from the talk about inflation and deflation and into the ground, how are gold miners going to bear up through the year?
An interesting question, because even now, with fuel costs, energy costs lower, and labor costs not exactly growing, the miners have certain advantages that they didn't have a few years ago to hold their costs down. On the other hand, the commodity demand for a lot of things that are extracted from the ground at great cost has decreased greatly. And I think it will continue to decrease if China's economy is imploding, as it would appear. Gold, in that sense, and this is something I've always, I'm not a gold bug, but I do believe that in any situation, whether we have a hyperinflation or a deflation, gold will hold its purchasing power. So I'm not one of those guys who's predicting $5 or $10 or $50,000 an ounce for gold, but I think it'll do pretty well relative to all other classes of investable assets.
Is there a particular cycle to it?
The meaningful cycle, I think, is really the ratio between gold and silver. And most recently, we've had it at, 80 to 1. And I think over time, especially if we are in the beginnings of a bull market in gold, we're going to see the ratio come down to more like 40 to 1, which would favor silver on a relative basis. But, to look at gold over the broad cycles, we've had increasing gold prices in both inflationary and deflationary times. And it's only over the very, very long cycles, we're talking centuries, where you could see, even then, it's difficult to see cycles and patterns because gold remained, let's say, undervalued for such a long time until Roosevelt confiscated gold. And later in the early 1970s, Nixon closed the gold window so that your dollars were no longer or money was no longer redeemable in gold. The Treasury was no longer offering that exchange.
Is there any alternative investment to hedge yourself if the stock market falls apart from gold?
Well, if the stock market falls apart, we're going to have worse than a bear market. It's only the fact that the market is trading, U.S. stocks are trading within putting distance of all-time highs, that we can contrive to ignore the much bigger problems, which in a nutshell imply a deflationary collapse. And there's so many reasons to think that this collapse would bring on a depression much worse than we experienced in the 30s, because in the 30s, maybe a third of the American population was involved in the agricultural economy. In that sense, we were living off the land. Today, job descriptions are so specialized that in many cases we don't know what our neighbors do. And we've got sort of just-in-time inventory for everything, a system that's running very efficiently, but which, as we've seen before, you get one little kink in the clearing system, in the banking sector, and all of a sudden everything starts to unravel. So we had a sound dollar in the 30s as well, and it's going to be most peculiar if we have another depression, because this time we will have the physical infrastructure and trappings of a very affluent society, but what you wind up with is people riding to the soup kitchens on $5,000 composite trail bikes. So in the worst of circumstances, probably the best asset you can have is farmland. And I'm always telling my subscribers who are hoarding doubloons in their backyard that they better be nimble if they want to exchange those their Krugerrands for farmland in that possibly brief window of hyperinflation that we could have. And again, I don't expect it, but I do think it's possible to have a hyperinflation, not through accident. There has to be a policy decision that either inadvertently or deliberately triggers a hyperinflation. I don't think that's what's coming, but if we have it, then you better pay off your mortgage before we implode back into deflation. You know, if you can peel off a few bills of hyperinflated money and pay off your mortgage, that'll be the way to go. But it's hard to imagine that we're ever going to be, we mortgage debtors are going to be so blessed as to be able to stiff our creditors in that way.
Are governments counting on doing that, considering so many have such sky-high debts?
I don't think anybody's counting on anything, really, or if they are, they're going to be sadly mistaken. There are no shortage of conspiracy theories that the banksters want to own it all, but what's the point of owning it if all they can extract as value from their ownership is rent income? And of course, rent income as it would have been in the 30s would be very depressed. So I don't believe the business about the banks sort of wanting to own it all. And the course, economically speaking and financially, that a depression would take is beyond predicting, other than the fact that we would all be considerably worse off. And one other thing is that there's really no way to make your fortune in a deflation. You're essentially in a process where all assets are deleveraging, and of course it's only in the other environment, in inflation, where people make their money, where, people with penny shares, insider shares that they bought for 10 cents a piece eventually trade at $80 or $90. That's how the big money is made. So in a deflationary bust, I would say even the geniuses, the Warren Buffetts, would be doing well just to hold on to a significant part of the assets that they currently hold.
Well, I've been told the secret to wealth is not so much making it, but keeping it in bad times.
And even now, that's tricky. These aren't exactly bad times. This is sort of like the calm before the storm. But what a challenge it is to take huge chunks of money. The companies themselves that are sitting on all this surplus cash, they have nothing better to do with it than park it in savings accounts. And as you know, in Europe, if you do that, you get charged for it. That's the effect of a negative interest rate. So, Soros ducked out of the hedge fund business a few years ago because even he couldn't beat his own benchmark. He was looking for 8% or whatever, and these days nobody's making 8%. So it's a very challenging environment, and I guess we should all have that challenge of wondering what to do with our $1 billion. But if you had $1 billion, where the heck would you put it?
Well, that's why we interview people like you trying to find out where to put our dollars, except, as you said, few of us have $1 billion to worry about. It's the, few thousand that you've tucked away for retirement. Is that worth anything?
Well, one thing we've talked about, I think, is that if I were actually allocating assets right now, I'd probably have 15 or 20% of it in gold for the reasons I mentioned earlier, but a good piece of it would be in long-term U.S. Treasuries. And to me, that's really one of the big no-brainers. It definitely goes against the grain to the extent that if you're expecting inflation, let alone hyperinflation, the bonds are going to be worthless. But I think that even if that day comes, we're going through a period where the whole world is just on the brink of recession. And not only that, but you can see whenever the global financiers are spooked, they dive right into treasuries. There's some countervailing pressures right now in that China, Russia are selling off a good part of the treasury holdings, but you can see that even with that going on, the long-term bond has only been in a consolidation of the enormous run-up that it had earlier in the year. So my long-term forecast for interest rates, or my forecast for the long bond, is an interest rate of 1.64%. And if things go that way, there's a huge capital gain for anybody in bonds because, of course, bond prices correlate inversely with yields. So I would definitely keep a part of my assets in treasuries, and that's been a no-brainer over the last 30-plus years. We've been in a bull market for T-bonds almost forever, and everybody thinks, well, now it's all going to change and we're going to have inflation. I say that's a lot of malarkey, and that bonds are probably the best place to be.
Well, inflation usually means things are growing, and they're not, are they?
Growing's an interesting word. You have, but yes, inflation means that the value of your dollar has been cheapened. But the best, the monetarists always stick with the stupid, simplistic definition of, inflation is an increase in the money supply, deflation is a decrease. But we have so many things these days that are fungible as money, very esoteric financial instruments, that nobody can really count at all. So rather than try to, figure out how much money is out there, for me, the way to recognize deflation is to consider only its chief symptom. Deflation is an increase in the real burden of debt. And we were somewhat unburdened in the bailout from the 2007-08 crisis because, pushing interest rates down allowed homeowners to refinance down to 3% or so. These were mortgages that were up above 5%. So in that way, we added a great deal of liquidity to the household sector. But my prediction all along is that at some point, even a 3% mortgage would become a crushing burden. And we've seen how that would happen in the 2007-2008 experience, because you may have a 3% mortgage, but when the value of your underlying asset, namely your home, is falling by 15% a year, your 3% mortgage works out to 33% real over a couple of years. So I think that's going to happen. And even though 3% mortgages are comfortable now, the underlying collateral is really shaky, and you see that particularly in California and obviously where you live up in Vancouver, that people who can't really afford these houses, these crummy little houses, are paying astronomical prices for them. And you think it's crazy, but the fact is it really is crazy, and craziness will ultimately have some consequences.
Rick, is it time for us to refigure out how to have an accurate GDP?
I don't think it's necessary. GDP is a fiction that supports fiscal and monetary policy. That's the only reason it exists. But you and I don't need a GDP because we know, just looking around at the local strip malls and talking to our neighbors, what the economy's really doing.
Rick, thank you very much for chatting with us.
Well, it's been a pleasure, Jim. Thanks for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He was speaking to us from Superior, Colorado. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions or comments for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.